Hello and welcome to episode 50 of the Special Situations Report, a podcast by Inside Arbitrage covering the most intriguing event-driven activity over the past week. My name is Asif Suria.
And my name is Tamanna Suria.
And what we will cover on the podcast today is just a small part of what happened in the special situations world last week. For daily updates and alerts on special situations, as well as access to tools that help you identify opportunities, such as a merger arbitrage tool, check out insidearbitrage.com. And also, please take a moment to like and subscribe to this podcast on whatever platform you might be listening on.
To kick off our second episode of the season, we wanted to cover 5 key stories, including a potential acquisition of the oil and gas fracking company Coterra by Devon Energy, 2 back-to-back acquisitions by Eli Lilly, a $2 billion stock buyback announcement by the SaaS company Veeva Systems, a fascinating insider purchase at Micron Technology by the former CEO of TSMC, and management changes at Under Armour, which incidentally also saw insider buying by Prem Watsa. Before we begin, we want to state that nothing on this podcast is meant as investment advice, and please refer to our full disclaimer at the end of the podcast for more detail.
Ideally, we should be kicking off this podcast discussing the most interesting merger situation right now, which is the acquisition of Warner Brothers Discovery by Netflix and the bidding war between Netflix and Paramount. But since Gary came on as a guest and did an outstanding job covering that last week, we can let that rest for a week and we can come back to it to cover the rest of the drama as it unfolds. To start this episode, let's talk about a potential deal or a rumored deal that we'd like to call deals in the works. 2025 was not just a blockbuster year for M&A and public markets with over 206 completed deals, but we also had 190 deals in the works situations. So as you know, we've been tracking these potential deal situations for 9 years, and we also track how many of these actually come to fruition and lead to definitive merger agreements. One of these rumored deals that I participated in personally was the shale oil production company Pioneer Natural Resources, which was acquired by ExxonMobil. I'm not sure if you remember the hilarious presentation by David Einhorn's Greenlight Capital about the oil companies that focus on fracking being ripe for shorting. One of the companies he discusses in that presentation is Pioneer Natural Resources, and I've mentioned in this podcast before that presentation actually helped me make money on the long side of oil frackers. The acquisition rumor for the acquisition of Pioneer by Exxon ended up coming true, and Pioneer was trading at about $215 per share when the Wall Street Journal reported that a deal was likely in April 2023. We wrote about the company for an April mid-month update, and the deal was confirmed in early October for about $255 per share. But it was unfortunately structured as an all-stock deal, which meant that if you wanted to participate in the merger arbitrage situation, you would have had to short the stock of ExxonMobil. The potential deal we want to talk about this week reminds me very much of that situation because it happens to be a large deal in the oil patch and is very likely to be an all-stock deal. So last week, Reuters reported that Devon Energy and Coterra Energy are exploring a potential merger in a deal that would create one of the largest independent US shale oil producers. I had a position in one of the best operators in the shale oil industry, Diamondback Energy, for several years and decided to exit last year after CEO Travis Tice, who had led the company for 13 years, decided to retire. Despite what is generally considered a very difficult industry to operate in, Diamondback generated gains of over 1,000% during his tenure, which in itself is quite an achievement, and to do that in the oil and gas patch is just phenomenal. The other interesting thing about Diamondback that we've discussed in the past episodes was the use of names of snakes for its subsidiaries. For example, its midstream operations that transport and store oil and gas were called Rattler Midstream, which Diamondback eventually fully acquired, and its royalty operations are called Viper Energy.
Always nice to see the snake-related names. So have you already done some comparisons between Pioneer and then Devon and Coterra? I'm curious, how might you compare Diamondback with these 2 other businesses?
Yeah, to put things in perspective, Diamondback has a market cap of $43 billion and an enterprise value of $66 billion. So most of these end up with a lot of debt on their balance sheet. In contrast, Devon has a market cap of nearly $23 billion and an enterprise value of $30 billion. Coterra is also a large company with a market cap approaching $20 billion and an enterprise value of a little under $24 billion. So the combined Devon and Coterra will still be smaller than Diamondback and EOG Resources.
I mean, given how large these businesses are they solely oil and gas producers, or do they have any assets related to mining, for example?
Yeah, Devon and Coterra are both focused on oil and gas production. So unlike the oil majors like ExxonMobil or Chevron, they don't have midstream assets or downstream assets like refining capacity or gas stations. They're both shale oil drillers that are entirely onshore and in the US. The production mix for them, however, diverges. While Devon's production is almost evenly split between oil and gas, Coterra's production is majority gas and natural gas liquids. So this focus on gas might be one of the reasons Devon might be interested in Coterra at this point. While WTI crude oil has declined from over $75 per barrel a year ago to just under $60 per barrel recently, natural gas has held up much better and even had a big rally in December. The whole situation is interesting to me because a few years ago, a lot of the natural gas producers were trying to move their mix to more oil rather than natural gas, and now it seems like the pendulum has swung on the other side. Despite what is considered a very difficult environment for oil and gas companies, Coterra generated more than $1.4 billion in free cash flow over the last 4 quarters, and Devon generated over $3 billion in free cash flow. In an area that is defined by drill baby drill and little discipline in capital investments, these companies have been doing an excellent job. Interestingly enough, Coterra trades at a forward EV by EBITDA of 5 and Devon of just 4. Both of them pay a dividend, but Coterra's yield of 3.42% is higher than Devon's annual yield of 2.65%, although Devon's payout ratio of 22% is one of the lowest in the oil patch. I see low antitrust risk if this deal were to be announced, as there are a large number of upstream operators, and regulators allowed both the Exxon Pioneer deal as well as the Chevron Hess deals to go through.
Continuing on with the theme of deals in the works, Eli Lilly has been on the move over the last few weeks, having been involved in not just one, but 2 different deals in the works situations, one of which played out and one of which hasn't quite yet come to fruition. On January 6th, the Wall Street Journal reported that Eli Lilly was in advanced talks to acquire Ventyx Biosciences for more than $1 billion. Ventyx is a clinical stage biotech that's developing treatments for various inflammatory diseases, signaling an expansion beyond Eli Lilly's historical and blockbuster diabetes and weight loss drugs. That being said, Ventyx does have a phase 2 drug to treat a cardiovascular condition linked to obesity, which could pair well with Eli Lilly's existing portfolio. The deal was officially announced a day later on January 7th, with Eli Lilly acquiring the business for $14 per share, only a 2% premium from the stock's last close, but over 100% premium from the pre-deal rumor price, considering that the stock was trading at the $7 range.
Yeah, that's why it's important to pay attention to the pre-deal rumor price, right? Otherwise, if you're thinking about deal break price or thinking about premium paid, you have the wrong data. So what's this other deal with Eli Lilly that happened last week?
Yeah, it's interesting because for a company that just hit over $1 trillion in market value last year, and now I think they're somewhere around the $900 billion range, it's unsurprising that Eli Lilly is continuing to push for expansion, and this week it seems as if they're going international. At the end of 2025, the French biotech company Abivax saw its shares jump by over 20% on rumors that Eli Lilly was weighing a potential acquisition. This week, the Wall Street Journal reported that Eli Lilly was ready to offer 15 billion euros, or $17.45 billion, for the biotech business, but is awaiting an indication from the French regulators on whether or not a bid would be subject to France's foreign investment rules. This deal would turn out to be much, much larger than the $1.2 billion acquisition of Ventyx, but interestingly enough, Abivax is also working to develop a drug to treat ulcerative colitis and other inflammatory diseases, essentially operating in the same space that Ventyx is. I'm wondering whether or not this is the next therapeutic area that Eli Lilly is hoping to establish a significant presence in, now that they already dominate both the diabetes treatment and obesity spaces.
I'm glad you mentioned the cross-border situation. So if there are cross-border deals, usually we talk about how CFIUS, which is the organization in the US that looks at cross-border deals, has to greenlight the deal. But in this case, a French organization that's similar on that side has to greenlight this deal.
Yes.
And considering the newly announced tariffs against Europe
Yeah.
by Trump, I wonder if they might actually drag this process out, even if they eventually end up approving the deal after it is announced and if it is announced. But something to keep in mind as we think about some of these cross border deals, we might start seeing larger spreads on them because of geopolitical issues, as you would call them.
If a deal even materializes in this case, because keep in mind it's a deals in the work situation, if the
Yep.
regulatory environment with all the tariffs just turns out to be too tumultuous for Eli Lilly to consider an acquisition, they might not acquire the business at all.
Absolutely, exactly. So that's going to be a big consideration for them and the investment bankers as they think about these deals. Switching to deal updates, this isn't exactly a current deal, but it is worth mentioning that Star Surgical, which was supposed to be acquired by Alcon, that deal fell apart on January 6th due to shareholder opposition. The stock declined an additional 6% after termination to $20.97, but interestingly, still trades above the pre-deal price. It is worth mentioning that we saw insider buying by Broadwood Partners after deal termination. They were one of three funds that were heavily opposed to the Alcon deal, and they had a sizable position going into this acquisition. The fallout from the deal also resulted in the resignation of the CEO, Stephen Farrell, and the board chair, Elizabeth Yu, last week.
I'm curious to see if Star Surgical can remain above the pre-deal price, or this might turn into Tasca's Part 2, where all the shareholders voted down the deal in hopes of getting a higher price, but the net stock now trades at a price well below the original offer.
Yeah, and I have a position in Taskas because I felt like the underlying business had tremendous value, just like the opposing shareholders were mentioning. I haven't quite made up my mind about Star Surgical. Stock has declined, if I'm not mistaken, 75% or at least 2/3 over the last 5 years. And this is a company sorely in need of a turnaround.
Exactly. Continuing on to our announced M&A section, as we mentioned earlier, 2025 was a phenomenal year for M&A, and 2026 is shaping up to be no different. This week, we saw the first major healthcare transaction, or the first major official healthcare transaction of 2026, Boston Scientific acquiring the medtech firm Penumbra, in a deal valued at $14.5 billion. Just to demonstrate how significant this deal is, it's Boston Scientific's biggest acquisition in the past 20 years and meant to expand its presence in the treatment of blood clots and strokes. The deal is a cash or stock consideration, valuing each Penumbra share at $374, which shareholders can elect to receive in cash or 3.87 shares of Boston Scientific common stock. The spread on the deal is currently 6.62%. For a little bit of context, Boston Scientific is a global medical device company and one of the two leading companies in the US focused on cardiovascular treatments, while Penumbra, on the other hand, is a leader in thrombectomy, which is the removal of blood clots, and embolization, which is a minimally invasive procedure to block specific blood vessels. The acquisition adds a fast-growing neurovascular and peripheral vascular segments to Boston Scientific's heart device portfolio. In a bit of a full circle moment, one of the first deals we ever talked about on this podcast, all the way back in episode 1, was the US-based Stryker signing a $4.9 billion deal to acquire Inari Medical. That deal, much like this one, followed the trend of medtech companies expanding their cardiovascular businesses through internal research and acquisitions, as aging populations and a rising number of heart conditions drive demand. The spread that remains on this deal indicates that not everything is cut and dry, and there seems to be some risk inherent to the acquisition. The FTC could review the thrombectomy business of both companies and issue a second request if it finds overlap. Antitrust review is thus mostly going to be focused on overlapping product lines in thrombectomy and related catheter systems, where companies sell into similar hospital markets, and could require divestitures or other remedies if regulators see competitive harm. Otherwise, the companies have a reasonable chance of clearing the deal without major hurdles, and the annualized return could turn out to be more attractive than it appears at the moment.
Some of these deals, the biotech deals, usually tend to close in just 2 or 3 months, compared to, on average, most deals taking about 4 months. In this case, they have guided towards a close of 2026, which could mean all the way to the end of 2026. And they have an extension to their outside date that goes on a year beyond that, all the way to 2028. So that shows that they are concerned about antitrust review, given the size of this deal.
Yep, exactly. With deals of this size, it's expected that some level of regulatory scrutiny should be expected, especially given that, again, this is Boston Scientific's largest acquisition in the past 20 years. So it deviates from their standard or their norm.
Exactly. And talking about antitrust, I was reminded of Spirit Airlines and the acquisition by JetBlue that fell apart. Has a special place in my heart because of the losses it generated for me. And I was reminded of that once again when we saw two discount airlines decide to do merge. And this was the acquisition of Sun Country Airlines by Allegiant Airlines in a deal that is worth just $1.5 billion. Interestingly enough, the spread on this deal is just 2.17%. And so that tells you that people are not worried about regulatory concerns with these two discount airlines merging, just as they probably wouldn't have been concerned about Spirit and Frontier merging.
To wrap up our M&A section for this week's episode, a company that I keep bringing up on this podcast, primarily because I'm the world's biggest avocado fan, is Calavo Growers. In past episodes, we've talked about a C-suite transition at the business, a series of insider purchases, and a rumored bid for the company that was brewing back in June 2025 at a price of $32 per share. A lot of the deals in the works discussion on this podcast tends to work out quite well, and investors who are able to get in on the deal in the brief period between the rumor and the actual deal announcement end up doing somewhat okay for themselves. But that's not always the case, and Calavo is a pretty good case study. It was announced this week that the avocado producer would be acquired by Mission Produce, another large avocado grower, in a $430 million cash plus stock deal that values each share of Calavo at $27 per share. This is quite a discount from the $32 price touted earlier, but Calavo's stock had dipped the high teens range in November following a leadership change and decline in volumes. The deal is expected to close at the end of August 2026, which may not be the most satisfying end to this special situation saga, but it'll be an interesting finish nonetheless. The deal did eventually end up coming through, albeit at a slightly lower price.
The FTC or the DOJ will have to look and see if the price of your guacamole could go up as a result of this deal coming to fruition. Let's switch over to spin-offs. We had one spin-off situation announced last week where the defense company L3Harris Technologies has decided to spin off its missile solutions business into a separately traded public company backed by a $1 billion minority investment from the US Department of Defense. The Pentagon's investment in this deal is going to be through preferred shares, and they're expecting this IPO to happen in the second half of this year. So as the spin-off progresses over the next few weeks and months, we might cover it in more detail in a future episode.
It'll be interesting to see play out for sure. Moving on to the buyback section of this podcast, we're going to cover a company that I've been following personally for a little over a year, Veeva Systems. Earlier this month, the company announced a $2 billion buyback, representing about 5.5% of its market cap at announcement. Though the size of the buyback is somewhat small compared to the cannibals that regularly repurchase over 10% of their market cap every other year or so, we still found this buyback significant, considering that Veeva has historically prioritized retaining earnings to fund the development, expansion, and long-term growth of its business, with little emphasis on direct shareholder returns. The business has never paid a cash dividend or announced a share repurchase program until now, meaning shareholder returns have largely depended on stock price appreciation.
As it usually does with growth companies, it might be worth talking about what exactly does Veeva Systems do. I know they are in the outer Bay Area, if you will, but haven't really looked at what this company does.
That's a great point. So Veeva is the leading provider of cloud software, data, and business consulting solutions exclusively for the life sciences industry. The company's moat comes from its SaaS-based platform that covers the full drug development and launch cycle. Veeva's products reach pharmaceutical, biotech, and medical device companies, as well as contract research organizations, CROs, something we've discussed on this podcast a number of times, and contract sales organizations, or CSOs. Its consumer base is deeply entrenched across the healthcare industry, with over 1,400 customers globally, including big names such as Bayer, Eli Lilly, which we just talked about, Gilead Sciences, Merck, and Novartis. In fact, the company currently supports 19 out of the world's 20 largest pharmaceutical companies. Key products include Veeva Vault for regulated document and content management, Veeva CRM for commercial teams, and then Veeva Network for mastering data on customers, healthcare providers, hospitals, and clinical relationships. Veeva CRM is going to be the main talk here because it was historically built upon the Salesforce CRM platform. But in December 2022, the company announced that it would split from Salesforce and build an independent Vault CRM platform, citing growing platform risk, limited customization, and rising costs. This migration was finally completed in September 2025. Under the wind-down agreement, Veeva is restricted from selling Salesforce CRM to new customers for 5 years after September 2025, and starting in September 2030, the Salesforce-based CRM can no longer be sold at all.
So how has this transaction impacted the business? I know rewriting software and making such a big switch can be quite disruptive to a business.
It's interesting because it's played out in a couple different ways. CRM now only contributes about 20% of revenue for the business, which is down from about 25% 2 years ago, but that's mainly due to faster growth in its other business segments. Adoption momentum remains pretty strong with over 115 customers live on Vault CRM, including top-tier accounts highlighted by Roche expanding its partnership around Vault CRM and Novo Nordisk also committing to Vault CRM. But not all news is good news when it comes to the CRM platform. Veeva currently anticipates that only about 14 of the top 20 pharmaceutical giants will select Vault CRM. While this still is a strong majority, that is slightly lower than the original internal projections. This shortfall represents a pretty notable risk because Veeva has fairly high revenue concentration among its largest clients, with the company's top 10 customers representing about 28% of revenue in fiscal 2025. Meaning losing even a few of these flagship accounts could cause a possible slowdown in growth and margins.
So in addition to investor perception that AI can start replacing these software companies, you now have a situation internally with the company switching its platform and potentially losing some customers, at least for the CRM part of its solution.
Exactly, and that's what's caused investors to beat the stock down hard over the last couple months. Veeva had soared in the first half of 2025, but at this point, it's down about 20% in the last 3 months. And that's caused by, yes, the concerns surrounding AI, concerns surrounding the customer losses, but also an actual slowdown in growth and margin contraction predicted for the next few quarters ahead by the company's management. We've written a far more comprehensive article on Veeva in our Buyback Wednesdays post on Inside Arbitrage, so make sure to check that out for more detail. But overall, Veeva seems to be an exceptional business with a strong moat. They truly are the provider for the life sciences industry, and they are driven by some fairly strong recurring subscription revenue, high customer retention, and expansion into multiple verticals within the life sciences space and workflows there. The newly announced share buyback also adds a shareholder-friendly catalyst, but valuation remains a key issue. Even after pulling back from historical levels, the stock still looks expensive at a trailing 12 months PE of 43 and leaves room for further multiple compression. Another concern, as you just mentioned, will be AI investments compressing margins, as the company itself highlighted in its 2030 target.
The Buyback Wednesdays article on Inside Arbitrage that you just mentioned actually will come out tomorrow. So people can look for it after that point in time. We were excited to write about the company as we do once a month by focusing on one company that announced a buyback. Switching gears to insiders, we wanted to discuss the largest insider purchase in over 15 years at Micron Technology. This is probably one of my favorite insider situations, and we came across it last Thursday night when you and I were reviewing insider purchases from that day for inclusion in the Friday event-driven monitor. I made a mental note about the transaction and decided to expand on it in our last Insider Weekends article. Before we dive into the specifics of the insider purchase, most of our listeners are likely already familiar with what Micron does, but it is worth mentioning that this Boise, Idaho-based company that holds over 60,000 patents primarily sells two kinds of memory: including the type that is used for your computer's drive to store data, which is known as NAND memory, and the other rapid access RAM memory that your computer uses as its temporary working memory while the CPU or the GPU is computing data. This more rapid access RAM memory is called DRAM kind of memory. I described this in the article as the distinction between your brain using working memory to keep track of which cards have been played in a game of bridge or blackjack and the words you need to remember as you are learning a new language. When Micron reported fiscal Q1 2026 results for the quarter that ended on November 27th, 2025, it generated 79% of its nearly $14 billion in quarterly revenue from DRAM sales and 20% from NAND sales. DRAM sales were up 69% year over year, and NAND sales were up 22%. These stellar results weren't a one quarter event, and the financials over the last 8 quarters are a sight to behold.
This explosion, both in terms of stock price and financial results, very much reminds me of NVIDIA's trajectory, doesn't it?
In many ways, Micron right now does remind me of what NVIDIA looked like a couple of years ago. The stock, which at one point during the tariff-related fears of last April had dipped below $65 per share, has recently gone parabolic and trades at $362.75 per share. Incidentally, the company also scores a perfect 100 in our IA score quantitative model.
So I guess the question on every investor's minds, and for listeners of this podcast who aren't as familiar with the business, what's been driving these stellar results?
Yeah, as at an investor pitch lunch in July 2024, a friend who works at Google pitched Micron because he felt that the high bandwidth memory, or HBM, which was specifically developed for applications like AI and machine learning and high performance computing, in conjunction with GPUs, would benefit companies like Micron that produce them. He mentioned that NVIDIA's Blackwell B200 chip, which was announced in 2024, would have 192 gigabytes of onboard memory. Another friend also picked Micron during an investor lunch in early 2025 for the same reason. NVIDIA Blackwell Ultra B300, which was announced in March 2025, had a capacity for 288 gigabytes of onboard memory. So basically what you're seeing is each successive generation of NVIDIA chips has larger and larger amounts of onboard memory. While traditional NAND memory was going through pricing pressures due to the cyclical nature of flash memory, HBM had pricing power due to the big increase in demand related to GPUs and Google's custom developed processors, tensor processing units, which are also known as TPUs. All of that changed towards the end of 2025 as demand for GPUs and memory started going through the roof with projects like OpenAI's Stargate locking up supply. Micron mentioned that it sold out of memory for 2026 and has had to move production from traditional memory for computers and devices to HBM. This shift created a tailwind for NAND memory as well and was a contributing factor in SanDisk's 751% rise since its spin-off from Western Digital last February. We wrote about Western Digital and the spin-off, but I don't think we anticipate this kind of a response and such a sudden turn in the cycle in NAND memory that we saw last year. Getting back to the insider purchase, director Tien Liu had 2,710 shares before he decided to pick up 23,200 shares last week at an average price of $337.14 for a total of nearly $8 million. This is his first insider purchase of Micron since he joined the board in March 2025 and is also the first insider purchase of any kind at Micron in over 8 years. To learn more about him, I clicked on the AI chat button on Tien Liu's page on Inside Arbitrage to see when he joined Micron's board. New directors often buy stock, and we view that as a weak signal. Mr. Liu spent 30 years at TSMC, where he was a co-CEO from 2013 to 2018 before becoming the executive chairman from 2018 to 2024. He received his PhD in electrical engineering and computer science from the University of California, Berkeley, and actually started his career at Intel. Given his vast experience, and especially at TSMC, his insider purchase signals that he sees additional value in Micron in the coming quarters. Computer memory has traditionally been a highly cyclical market, with suppliers such as Samsung, SK Hynix, SanDisk, and Micron increasing capital investments to increase supply when demand is running high. This eventually leads to lower prices and earnings for this group of companies, usually craters. Investors who are not attuned to cycles often get attracted by low valuation metrics at the peak of the cycle and avoid these companies at the trough when trailing valuations look high, and which should be exactly when they should be participating in these companies. Semiconductor companies used to be similarly cyclical until the AI and Bitcoin boom made them secular growers. Until we see a pullback in AI infrastructure spending, it is possible that memory companies might follow the same trajectory that semiconductor companies did the last few years.
So yeah, this is a really, really interesting company and a really interesting insider purchase as well. Very much fits the playbook of what we'd like to look at when we see an insider purchase. Long-serving director with a deep industry background, making his first purchase in quite some time. So the story seemed really perfect. I was wondering what the key risks might be associated with this business.
Yeah, the key risk for Micron is a potential bursting of the AI bubble and a big pullback in infrastructure spending just as the company is ramping up production through $100 billion fabrication plant investment in New York. And last Saturday, they announced the acquisition of a chip fabrication site in Taiwan for $1.8 billion. So you can see that these companies, Samsung, Micron, they are going to ramp up production and make investments, and so maybe it doesn't turn into a secular growth story like we saw with semiconductors, and maybe the cyclical nature of it brings it down eventually.
Yep, will be really interesting to see how that all plays out. So continuing on with the insider theme, but moving on to the C-suite section of this podcast, another business that we've been following for quite some time is the sports and athletic apparel and accessories business, Under Armour. We first noticed the company in August of last year after seeing 4 different insiders purchase shares, including the CEO and CIO of Sora's fund, the president of Sycamore Partners, and another interesting purchase came from the chairman of the business, who joined Under Armour in 2018 and had just made his first ever purchase of the company. Unfortunately, while on the surface nothing appeared wrong with the purchases, they were open market transactions and didn't appear to be part of a director compensation plan. We dug through a few SEC filings and eventually found, in May 2021, director stock ownership requirement. The mandate required that all directors must own Under Armour stock valued at 5 times their annual retainer, with 5 years to achieve compliance. While the exact director compensation remains unknown, the purchases totaled up to around $500,000 worth of Under Armour stock for each director, which would satisfy or at least partially satisfy the holding requirements. Now, the example was a pretty good case study in how there might be more to insider purchases than what meets the eye. However, we revisited Under Armour just over 2 weeks ago in the context of insider purchases once again. At the start of January, we saw Prem Watsa, the founder and CEO of Fairfax Financial, purchase over $140 million of Under Armour stock.
For investors that might not be familiar with Prem Watsa, can you talk a little bit about who he is?
Yeah, so we can go back to 1985 when Prem Watsa took control of Markel Financial, a Canadian trucking insurance business, and renamed it Fairfax Financial. Since then, Fairfax has grown through a series of acquisitions into a business primarily engaged in property and casualty insurance, reinsurance, and associated investment management. Fairfax and Prem Watsa have long been compared to Berkshire Hathaway and Warren Buffett, and it's interesting to see how both companies have performed in recent years. Berkshire's stock price is up about 10% in the last year, and up 117% in the last 5 years, which is certainly impressive, but pales in comparison to the 38% that Fairfax stock has returned in the last year, and the 460% rise in the Canadian company's stock price over a 5-year period. Unlike the other big-name insiders involved with Under Armour, as discussed earlier, Mr. Watsa is actually not part of Under Armour's board. Instead, he's explicitly expressed that he is treating Under Armour as a pure-play value investment, seeking no board representation. He also already had a 10% stake in the business prior to this large purchase, and given that he was purchasing both Class A and Class C shares, the latter of which has no voting interest, it's likely that Mr. Watsa was truly purchasing these shares for the economic interest alone, as opposed to trying to increase his voting influence.
So why do you think Mr. Watsa is continuing to purchase shares at these levels?
Honestly, that's a bit of the confusing part. Under Armour has seen its stock price drop 33% in the last year and has lost over two-thirds of its value in the last 5 years. The drop in the stock price is completely understandable given the company's financial decline over the same period. The company last reported fiscal Q2 2026 earnings, which saw revenue decline 5% year over year, and ended up reporting a net loss of $19 million, as opposed to net income of $170 million, recorded in the same period a year prior. Around the same time, Under Armour also ended their partnership with one of the most famous basketball players of all time, Steph Curry. He first signed with the brand in 2013 after his partnership with Nike ended, and in 2020 he created the Curry brand within Under Armour, expected to be a lifetime contract. However, following the split, the Curry brand is expected to be independent of the Under Armour business, adding to the extra restructuring costs hitting the bottom line. Under Armour's founder, Kevin Plank, served as CEO from its inception in 1996 till 2020, but stepped back into the role of CEO in 2024 after 2 consecutive years of annual sales declines. When he rejoined the business in 2024, he kicked off a turnaround plan that included product improvements, but also saw a new line of C-suite executives. The company's CFO announced in November that he would be stepping down from his role in February 2026 after spending 21 years with the business. He will be replaced by Reza Delankani, who joins Under Armour from Samsonite Group, the luggage manufacturer and retailer, where he served as EVP and CFO since 2018. This week, we also saw Under Armour's Chief Product Officer step down from her role, and Kara Trent, who had been Under Armour's President of the Americas, promoted to the role of Chief Merchandising Officer. The revolving door of C-suite executives at Under Armour, which includes departures from the company's Chief Commercial Officer and Chief People Officer since Kevin Plank returned to his role, is the hallmark of any new C-suite executive with a turnaround plan. Fixing a business starts from the top, and I wouldn't be surprised to see an entirely new C-suite team in the next few years. Now, whether or not Under Armour can actually be salvaged is a big question, and Prem Watsa has historically been caught in value traps like BlackBerry, where legacy impressions outweigh the current financial outlook. I personally don't share Mr. Watsa's enthusiasm for the business, but if the turnaround does succeed, this could easily be a 10-bagger in the next few years.
I think you did hit the nail on the head when you mentioned, traditional or legacy impressions outweighing the current financial outlook. I've seen this happen over and over again. We saw this with Eddie Lampert with Sears. We saw this with Bill Ackman with JCPenney. There's just something about brands from yesteryear that investors did not participate in during their heyday, and they come back to it years later hoping a turnaround might actually happen, and very few of them actually do happen. It'll be interesting to see how this plays out. I really hope Kevin Plank can turn around Under Armour and Prem Watsa makes a lot of money for us because we are shareholders of Fairfax Financials. And this is probably a point where I should mention we also own shares of Micron, Western Digital, and our clients might own stock in any of these companies mentioned on this podcast.
And with that, we will wrap up episode 50 of the Special Situations Report. What we covered today is just a brief overview of the special situations landscape. So if you'd like to access a more comprehensive weekly overview of all event-driven activity, go ahead and visit our website, thespecialsituationsreport.com, for daily updates and alerts on the special situations world, as well as access to tools to help you identify opportunities such as a merger arbitrage tool. Check out insidearbitrage.com.
And if you enjoyed this podcast, please take a moment to like and subscribe on whatever platform you may be listening on, and especially share it with your friends who are interested in special situations. Thank you.
We also wanted to provide a brief reminder that this podcast is for general informational and educational purposes only. The content does not constitute financial, investment, legal, or tax advice. We do not warrant the completeness or accuracy of the content or data provided in this podcast. Nothing discussed on this podcast should be interpreted as a recommendation to buy, sell, or hold any investment or security. Investing involves substantial risks, including the potential loss of principal. You should conduct your own research and due diligence before making any investment decisions. Thank you.